For venture capital investors, liquidity is a fundamental concern. While VC funding enables rapid growth, most portfolio companies operate with minimal immediate cash flow and uncertain exit timelines. Unlike traditional businesses that generate steady revenue and dividends, startups prioritize reinvestment, making cash flow management and exit timing crucial for both survival and long-term returns. For investors, managing liquidity requires balancing capital deployment across multiple portfolio companies while ensuring sufficient reserves for follow-on investments. Exit strategies must be carefully timed to optimize returns, whether through acquisitions, secondary sales, or IPOs. Understanding liquidity dynamics is essential for maximizing portfolio value and ensuring sustainable venture capital operations. Let's explore the key challenges and strategies involved in navigating liquidity in the VC landscape. Startups are inherently cash-hungry, often burning through capital long before reaching profitability. In the early stages, companies prioritize product development, customer acquisition, and scaling operations, but these efforts rarely generate sufficient revenue to sustain the business. Instead, they rely on external funding, venture capital, venture debt, or grants to stay afloat. For investors, this creates both an opportunity and a risk. While injecting capital fuels growth, poor cash flow management can doom even the most promising companies. A prime example is WeWork, which raised billions but burned through cash at an unsustainable rate, leading to a failed IPO and an emergency bailout. Even well-funded startups can collapse if they fail to balance aggressive expansion with financial discipline. For VCs, the lesson is clear. Evaluating a startup's burn rate, financial planning, and fundraising strategy is critical. Investors must ensure that portfolio companies not only secure funding, but also deploy capital efficiently to extend their runway and reach key milestones before their next raise. For venture capitalists, liquidity is just as complex. Unlike public market investors, VCs can't sell their stakes anytime they want. They must wait for an exit event, IPO, acquisition, or secondary sale, to cash out their investments. Since the average venture fund operates on a 10-year cycle, liquidity is a long-term play. However, many startups take longer to exit, creating challenges for funds that need to return capital to their limited partners. If exit markets slow down, like during economic downturns, VCs can face liquidity bottlenecks where they're stuck holding investments that haven't matured. This creates pressure to find alternative ways to unlock liquidity before the fund's life cycle ends. Investors must diversify their portfolio, structure funds with follow-on capital in mind, and plan exit strategies early to ensure liquidity when needed. Timing an exit in venture capital is both an art and a science, requiring a delicate balance between market conditions, investor expectations, and the ultimate goal maximizing returns while ensuring liquidity. For VCs, understanding when and how to exit is crucial to realizing gains and optimizing fund performance. One of the most sought-after exits is an initial public offering, IPO. An IPO enables a startup to raise capital from public markets while giving early investors and employees the opportunity to cash out. However, the path to an IPO is complex. Companies must meet strict financial and regulatory requirements, and the broader market environment needs to be favorable. Timing is critical. Airbnb, for example, postponed its IPO in 2020 due to pandemic-related uncertainty, choosing to wait for a more favorable market window. That patience paid off when the company went public later that year under significantly better conditions. For many VC-backed companies, an acquisition is a more common and often quicker route to liquidity. A successful acquisition can provide immediate returns, but there is always a trade-off. Selling too early may limit upside potential, while holding out for too long could mean missing a strong exit opportunity. Instagram's $1 billion acquisition by Facebook in 2012 is a prime example. At the time, it was considered a massive win, but in retrospect, Instagram's value could have been exponentially higher had it remained independent. Beyond IPOs and acquisitions, secondary sales offer another liquidity option. This allows early investors and employees to sell their shares in private transactions before a full exit event. While secondary markets provide flexibility, they also carry risks. Pricing can be uncertain, and selling too soon might mean missing out on significant future gains. Some early Facebook investors, for instance, sold shares before the company's IPO only to watch its valuation skyrocket post-listing. For VCs, exit timing should never be driven by short-term pressure. Instead, it must be a calculated decision based on company performance, industry trends, and the broader economic climate. Whether through an IPO, acquisition, or secondary sale, the best exits maximize long-term value and align with the overall investment strategy. Liquidity isn't just about when to exit, it's also about surviving long enough to make it to an exit. Challenging economic conditions such as downturns, rising interest rates, and shifting market trends can significantly slow initial public offering activity and reduce acquisition opportunities. As a result, achieving liquidity becomes much more difficult for both startups and their investors. When market conditions are unfavorable, startups need to prioritize sustainability. This means focusing on operational efficiency, cutting unnecessary costs, and doing everything possible to extend their financial runway. In such environments, maintaining resilience and adaptability becomes more important than aggressive growth. At the same time, venture capital firms must explore alternative paths to liquidity. One common strategy involves utilizing secondary markets, where investors can sell their equity to other interested buyers. Another approach is structuring investment deals with specific liquidity preferences, which helps ensure that investors have a better chance of realizing returns even in a challenging exit environment. In times of uncertainty, both startups and venture capital firms must adjust their strategies to protect value and navigate the longer path to liquidity. For example, during the 2008 financial crisis and the 2022 tech downturn, many startups had to delay exits, raise down rounds, or restructure their business models to survive. Liquidity strategies must be flexible. Good times bring easy exits, but downturns require patience and financial discipline. Venture capital is not solely about providing funding. It is equally about guiding startups towards sustainable and well-timed liquidity events. The most effective venture capital firms take an active role in helping startups prepare for these outcomes with foresight and discipline. One of the key ways they do this is by helping founders plan funding rounds strategically. Rather than raising capital reactively, great venture capitalists work with startups to anticipate future needs and structure fundraising in a way that avoids unexpected cash shortages. They also support founders by making valuable connections that can lead to acquisition opportunities or strategic partnerships. These relationships can pave the way to meaningful exits and long-term business value. Another important area of support involves encouraging financial discipline. Venture capital firms often help startups implement lean operating practices, making sure that resources are used efficiently and that the company can extend its runway when necessary. In addition, experienced venture capitalists look for ways to unlock liquidity even before a major exit event, like an initial public offering or acquisition. They may explore secondary markets or use structured financing solutions that allow early investors or founders to realize some returns while continuing to grow the business. Through these efforts, venture capital firms play a vital role in shaping not just the growth of startups, but also their long-term financial outcomes. Great investors don't just look at short-term returns. They ensure startups have a clear path to liquidity that benefits both founders and stakeholders. Liquidity planning isn't just about exits. It's about ensuring startups survive long enough to reach an exit. Liquidity is what separates successful startups from those that run out of cash and what makes VC investing profitable instead of just speculative. For startups, managing liquidity means balancing growth with financial discipline, ensuring they don't burn through capital too fast. For investors, it's about strategic exits, secondary markets, and timing market cycles to maximize returns. At the heart of it all is one golden rule: liquidity is not just about making money, it's about making the right money at the right time.